So recall we were given information on two companies, Moose and Beaver. We were told that as of December 31st, 2004, Beaver Company had 120,000 shares outstanding. Moose Company had 200,000 shares outstanding. These were the respective stock prices, $2 for Beaver, $5 for Moose. Moose has an unrecorded patent, and Beaver had ongoing litigation that's unrecorded. We're told here that assume here that Beaver Company acquired 100% of the common shares of Moose. So Beaver bought the shares of Moose in an all stock deal by issuing 480,000 new common shares. Okay, so you have Beaver Company, Beaver Inc., and Moose Inc. So Beaver Inc. has 120,000 shares, which are owned by shareholders of Beaver. And Moose Inc. has 200,000 shares owned by shareholders of Moose. Now what happens? Beaver buys all the shares of Moose in an all stock deal. So when Beaver buys the shares of Moose, who does Beaver buy the shares from? The shareholders, right? So what Beaver does is Beaver goes and buys all the shares of Moose. So basically replaces the shareholders of Moose by itself. So Beaver Inc. now becomes the new shareholder. And these 200,000 shares that Moose had outstanding, they now belong to Beaver. Okay? So Beaver has bought all the shares of Moose. And what has Beaver done? Beaver has not paid cash here. Beaver has paid, instead of paying cash, Beaver has issued 480,000 new common shares. So those common shares, who were they issued to? It's an all stock deal, okay? So that is clear that they didn't actually go sell the shares in the open market and use the cash to buy the shares of Moose. They actually issued the shares to someone. Who is that someone? Beaver issued 480,000 new shares. To whom? They issued shares to the shareholders of Moose, right? Absolutely. So these people that used to be shareholders of Moose, old shareholders of Moose, now become shareholders of Beaver. And these people now own 480,000 of Beaver's common shares. Now, you don't have to be a math whiz, just looking at the relative number of shares, which of these two parties will be the big daddy here now in Beaver? Who will have the majority? The big daddy is the old shareholders of Moose, right? I mean, they are with 480,000 shares, clearly they outnumber Beaver by a factor of 4-1, right? Out of the total 600,000 shares, right? After the acquisition, Old shareholders of Beaver own 120,000 shares of Beaver, and the old shareholders of Moose own 480,000 shares in Beaver. So out of a total of 600,000 shares, you're talking about 120,000 out of 600,000. We're talking about 20% being owned by the former shareholders of Beaver, and the rest, 80%, is owned by former shareholders of Moose. So who will have control now? It is the old shareholders of Moose will be in control after this deal. Now, this wasn't a Homer Simpson like Doe moment on the part of Beaver Company. This, keep in mind that professionals are typically involved here, lawyers are involved, and all of these aspects of the deal must have been clearly understood by all the parties involved here. So Beaver's shareholders have willingly gotten themselves into a situation where, on the surface, it seems like Beaver Company bought Moose, but the reality is that it's the former shareholders of Moose that are essentially taking over Beaver. So, from an accounting perspective, it is as if Moose Inc. has fired Beaver. Look, legally, Beaver Inc. has acquired Moose. There is a difference between the the legal aspect of it. So you guys probably remember from intermediate two the discussion around redeemable preferred shares. The company issues redeemable preferred shares. The legal form of the preferred shares is that they are equity, but from an accounting substance over form, the accounting treatment of those redeemable preferred shares is what? Does anyone remember? So I'm making a big leap of faith here now. I'm getting the sense that maybe the earlier courses are not being taught the way they used to in the past, and maybe they're being diluted. So have you guys heard of redeemable preferred shares? Preferred shares that can be bought back. Intermediate two, yeah, should be there, right? So if you guys talked about it, do you remember that now preferred shares legally are part of equity? But from an accounting point of view, how do we deal with them? How do we account for them? If preferred shares are redeemable, how are they reported on the balance sheet? Okay, and if you guys don't remember, it's fine. Don't feel sorry for yourself or bad for yourself. Good job there, Marnell. You remembered. Good. It is a liability. They're reported as a liability. Exactly. So, substance, the economic substance outweighs the legal form. Legally, preferred shares are equity. However, if they are redeemable, then basically, they are indistinguishable from a liability. The dividends are a fixed amount, so no different than the interest. And if they are to be redeemed, then the amount is ultimately payable back to the holders. So they are reported as a liability, right? And the dividend paid on those mandatorily redeemable preferred shares is actually reported as interest expense on the income statement, right? So this situation is a reverse acquisition. It's a reverse takeover. Legally, it looks like Beaver Company has bought the shares of Moose. But when you look at the way the deal is structured, it's clear that it's not the old shareholders of Beaver that are going to be in control, but rather people who used to own Moose. So, from an accounting point of view, it is as if Moose has acquired Beaver. This is a reverse acquisition, a reverse takeover. Okay, this is a reverse takeover. The acquirer for accounting purposes is Moose because the shareholders of Moose, the former owners of Moose, are not now going to be in control over the combined entity. So Beaver is the owner of Moose, right? So Beaver, from a legal point of view, will say, we own all the shares of Moose. But who will drive Beaver? Who will be in control over Beaver? It's the old shareholders of Moose. So that's the reverse takeover bit. These things happen a lot when you have a numbered company in Alberta. You know, a lot of these private companies, if they want to go public and they want to avoid all of the various hoops that they have to jump through to go public, they often go through this route. They will structure a deal whereby a list a listed company, a numbered shell company. There are a lot of these empty shell companies floating around. There is a company, it's listed on the stock exchange somewhere. There used to be the Alberta Stock Exchange, and you'll have these deals being stuck whereby the listed company will buy the private company, and the deal will be structured in a way that the private company ends up being in control, right? That's often a means of a backdoor entry to the stock markets. And absolutely, Maria, that is the fact because Beaver owns all the shares of Moose anyways. So if the old shareholders of Moose can control Beaver, they also have control over Moose. Okay. So this is a unique situation here where you have a reverse takeover. Now, when you see there is a reverse takeover, to calculate the acquisition cost, you have to do it in two steps. Okay. When you calculate the acquisition cost, first thing you got to do is calculate the number of notional shares. So this wouldn't actually happen. The number of notional shares that Moose should have issued to obtain the same percentage ownership. I'll explain with the numbers, it'll be easier. And secondly, you want to multiply the number of shares in part one by the market value of Moose Inc.'s. Okay, so first, after the deal is done, the old shareholders of Beaver own 20%, and the old shareholders of Moose own 80%. Now, notional means as if, right? So notional means as if, means it will not actually happen, right? Will not actually happen. So it's entirely make believe. Okay, you're pretending, you're doing a pretend calculation and say, instead of Beaver buying Moose, that's what happened legally, right? Legally, Beaver Company bought the shares of Moose. We're saying if instead of Beaver buying Moose, if Moose had purchased Beaver's shares. So just for a moment, pretend we're looking at Moose Inc., right? So Moose Inc. had 200,000 shares outstanding, which were owned by old shareholders of Moose. Now we're saying if the old shareholders of Moose, their percentage ownership is supposed to be 80%, then how many shares should have been issued to the old shareholders of Beaver so that after the shares are issued, the old shareholders of Beaver will own 20%. So if it had been Moose Company buying Beaver, how many shares will Moose Company, Moose Inc., have to issue so that after the share issue, the old shareholders of Moose will have 80% and the shareholders of Beaver will get 20%. So I'm seeing a couple of numbers here. Marlon and Frederick have offered the answers, and they are correct. How did they get that? Well, if 200,000 is 80%, 20% is 1,000, right? And you can check. If Moose issues an extra 50,000 shares, the total number of shares outstanding will become 250,000. Out of the 250,000, if the old shareholders of Moose continued with 200,000 shares, their percentage ownership will become 80%, and 50,000 shares for the old shareholders of Beaver will be equal to 20%. So 50,000 is the notional number of shares. That's part one. If Moose Company had purchased Beaver shares in an all-stock deal, Moose will need to have issued 50,000 shares of its own to bring the percentage ownerships the same as what we have right now. 20% old shareholders of Beaver, 80% old shareholders of Moose. Okay, does that make sense? It's a make-believe calculation. All right. Once you've got this number of shares, the notional number of shares, your acquisition cost is acquisition cost for accounting purposes is 50,000 shares multiplied by what is the market price of each share of Moose? $5. 50,000 times 5 works out to $250,000. Right? So this is the answer to part A. Identify the acquirer and the acquisition cost. So under IFRS, this is what would be the case. You first identify who is the acquirer, and if it is indeed a reverse takeover, then you got to first calculate the number of notional shares. Notional is make believe, not actually to be done. Moose is not actually issuing these shares. It's this is the number of shares that Moose will have issued to get the same outcome. Once you got the number of shares, multiply them by the market price of Moose's shares at that date. $5 in this case, that's 250,000. Okay. So if the acquirer is a public company, the acquisition cost is calculated as the notional number of shares to be issued to achieve the same percentage ownership multiplied by the market price of the acquirer's share. We just saw that. If the companies were private companies, the acquisition cost will be equal to the fair value of the acquired company's net assets. So answer to part B, if these were private companies. So if these were private companies, we will not have any market prices. Okay, I hope you will agree to that. If these are private companies, then we will not have this, the second piece of information, the market price. That information will not be available. Yeah. So if that second the market price information is not available because the companies are private companies, then the acquisition cost will be equal to, so who's the acquirer again? It's still the reverse takeover. Moose Inc. is the acquirer. So the acquiree, Beaver, these are Beaver's fair values. So fair values of all identifiable assets and liabilities. So net assets, fair values of all assets and liabilities. Okay. So part B, if the companies were private companies, then market prices will not be available. In this case, the acquirer is Moose, and the acquisition cost is the fair value of Beaver's net assets. Fair value of Beaver's net assets, which I believe we've already done the math up here. So these are the assets and these are the liabilities they took over. Right? So these were the assets of Beaver. These were the liabilities that we identified. The difference between the two is the acquisition cost. 200,000 is the acquisition cost. So this is not a journal entry, by the way, okay? This is just the calculation of the acquisition cost. You add up the assets, subtract the liabilities. Gives us the acquisition cost. Maybe I should put it here. The total of the assets, fair values, total of the liabilities, total minus this, that's your acquisition cost. Okay, are we good on this? I don't have other examples for this piece. This is not a huge thing, but it's still important enough that you should know. You live in Alberta, and Alberta is happy hunting grounds for these kinds of deals. So if you ever end up auditing a company where there had been a reverse takeover kind of situation, you should be aware of what that is, what that means. And very commonly, you'll find one of the companies is private. Usually it happens. The other thing that I've seen reverse takeovers being used is by foreign companies, typically companies from China, trying to gain access to capital markets in North America. They don't want to open up their books. They're pretty secretive, etc. And so what they would do is they would basically structure a deal like this so that a Chinese company will buy a listed company in North America, structure the deal so that it becomes a reverse takeover. So the Chinese company, basically, the management of the Chinese company gets control over the Canadian or the American company, and they will be able to tap the capital markets. And in audit, you folks will have, for those that are taking audit or recently took audit, you probably learned about Sino-Forest. You heard of Sino-Forest. It was a massive fraud. The company had been audited by Ernst& Young. It had E&Y partners serve on its board, and it was shown to be a complete fraud. Um, and it was a result of a reverse takeover. Okay, any questions on this point?